One UK city has seen price growth at over 40% in the last 6 years alone, whilst another major UK city with average property prices at around £1.3 million has stayed fairly stagnant. And I'm going to take a guess that you yourself have considered investing in the wrong one. We've spent 21 years selecting the right areas for our clients' next investments. And the biggest mistake that we see clients making is thinking more expensive property equals better returns. They spend their time chasing prestigious postcodes or prestigious cities because that's what people tell them to do. But the data actually shows something completely different. Some cities in the UK are expected to achieve capital growth of around 31% by 2029, with average rental yields sitting between 6 and 7%, whilst other cities in the UK are going to be set to achieve under 15% in capital appreciation in the same time period and a rental yield of sub 4%. If you invest into the wrong place in 2026, you could be tying up your cash into poor quality returning assets that don't yield well or appreciate well, making it a dead investment. So in this video, I'm going to reveal which areas are the best areas for both yield and capital appreciation in 2026, which are the areas that we believe should be avoided, areas with low growth potential, low yields, and maybe oversaturation for tenancy. And we're also going to show you the supporting data behind it all. People think high rental yield must mean a brilliant investment. And this can be true, but absolutely is not always the case. They see a 9% yield in some random town and think they've struck gold, when actually there are a lot more factors to be considering. Is the apartment that you've purchased going to be easy to rent out? Will it have void periods? How is the appreciation in that particular area? And what's the catalyst for that appreciation also? And finally, will they be able to resell it later down the line? Because as much as purchasing a great asset is hugely important, the ability to exit that asset in a clean and tidy way and making a profit is equally as important. To give you an example, a couple of years ago, I had a client that had bought themselves an apartment in Middlesbrough. It was an area that they thought they knew fairly well and had had some family that had lived there previously also. What they found after owning that apartment for a couple of years, the tenant demand in the area was low, which led to larger follow periods in the apartment and time where they were looking for its next tenant. But also, not only that, they actually found that the appreciation in that area over the following few years was virtually non-existent, which meant that when they decided to move their investment capital into a city that would perform a little bit higher, they ended up making no capital appreciation whatsoever by the time they paid their legal fees for selling the apartment. Yield is extremely important for buy-to-let, of course, but it's not the only piece of the puzzle. And actually, there are a number of other factors that you have to consider to round off what is a great investment. You need to look for an area that has some form of undersupply in property and a real genuine demand for rentals, maybe big employers nearby, major transport links, anything of this nature. And then you have to factor in the ability to make a strong capital appreciation. Usually, with capital appreciation, you will find that it comes from major regeneration projects happening nearby. These major regeneration projects will boost the specific area's value over time, which leads to the property you purchase increasing in value faster than areas that are not currently undergoing regeneration. You can find high rental yields where property prices are low and rents are high, but if there's no demand in the area for properties at that time, you'll have an empty apartment generating you zero rental income and actually costing you money each month. Not only that, if you're buying into areas that are not undergoing major regeneration, you'll also find when the time comes to sell the property, you'll potentially break even or could even make a loss. When evaluating any city, it's really important to look at the entire picture as a whole. You need to think about prospects for rental yield, tenant demand, prospects for the capital growth based on major construction projects going on in that specific area, big companies in the area, transport links. All of these things will assist you in picking which area is going to be the right area for your next investment. And remember, this video is for research purposes. We would always encourage clients to do their own due diligence and their own financial checks ahead of deciding where is going to be the best place for them to buy. Even the right cities require careful due diligence and realistic expectations, not just selecting from the list of top 10 cities and then picking one that suits them. I'm going to start with the areas that we believe you should avoid investing into in 2026. These areas are not necessarily bad places to live. In fact, many of them are some of the nicest places to live in the country. But just because an area is a nice place to live does not necessarily mean it's a great place to invest. Many of the areas I'm going to be discussing, in fact, will seriously underperform from an investment standpoint and provide you with significantly lower investment returns than when buying into multiple other areas in the country. Let's take Kensington and Chelsea for an example. These are some of the most prestigious postcodes in the entire country to live in. But actually, when you look at the data from an investment perspective, make terrible investments. You could end up tying huge sums of capital up into investments that end up making you significantly lower returns than areas that you can get into with significantly less capital. It makes no sense at all. In Kensington, for example, the average property price is over 1.3 million. Whereas, if looking at a city like Liverpool, average property price is closer to 181,000. Now, where it gets really interesting is that in Kensington, the stats show that by 2029, they may see price growth of up and around 15%. Whereas in Liverpool, they should see property value increases by over 31%, which means the appreciation on your investment has over doubled. And not only that, the capital required at entry point to get in and be able to purchase is significantly lower, meaning if you really wanted to, you could buy multiple assets using the same capital as only being able to buy one asset in Kensington. According to ONS data, the average rental yield in Kensington and Chelsea sits at around about 3.18%. Whereas, if you invest into a city like Liverpool, the average rental yield will sit somewhere between 6 and 7%, giving over double the yielded rental returns to you as an investor from your investment. When you couple that up with the appreciation statistics I've already given you, being around about 15% in Kensington or Chelsea and over 30% in Liverpool, it means that the overall package for the investment you're buying yields almost double when buying into Liverpool and appreciates over double when buying into Liverpool, giving you drastically higher investment returns with significantly lower capital outlay. It almost becomes a no-brainer. Unless you have exceptionally deep pockets and are literally just looking for somewhere for capital preservation, you have to think long and hard before deciding which area would be best for yourself. What we tend to see with people buying into areas like a Chelsea or a Kensington is that they're more vanity purchases of people who just want to own prestigious property in prestigious neighborhoods. Prestigious does not always mean high returning. So avoid these ultra premium areas, as your capital will work for you much harder when making strategic and calculated decisions in other parts of the UK. Another fantastic example of an area that is a beautiful place to go, but is not necessarily the best place to invest your hard-earned money, would be an area like Devon. Maybe you've been there on holiday with your family, had a great time, think it could be perfect for you to get a holiday let, or maybe a retiring property, something like this. But just because it was a great place that you spent time and created memories with your family doesn't necessarily mean it's going to give you the best return on your investment. What we find with areas like Devon is they're seasonal. In the summer months, it's going to do great as a holiday let. when the sun is shining, which, as we all know, is not very often in the UK. But in the winter months, the property will remain empty an awful lot, lower occupancy rates, and killing off any return you could potentially make. It leads to an investment that is very up and down, very seasonal, and very cyclical. And these are not necessarily the things you want from your investment when you could put your money somewhere that finds you a good tenant that is going to stay in there and provide you with year-long investment returns. To give you a good example of this, I had a client literally a month ago who had bought themselves a property in a place called Exmouth, which is in Devon. It's a coastal town, fantastic place to go for a holiday. But what they found once they bought the property is that 80% of the annual income being generated by that property was actually being generated at peak season in July and August, where it was entirely sold out and renting for a premium. But the rest of the year, they struggled to fill the property. It had tons of void periods. And of course, the rates were actually significantly lower because of the reduced demand. When we looked at a property with them in Liverpool on the same short-let basis and explained to them that we see average occupancy yields across the year between 60 and 75%, they realized very quickly that they could make significantly higher profits from buying a very similar short-lettable apartment, but actually buying it in Liverpool rather than a more seasonal town. According to ONS data, the average rental yield in Devon sits at 3.31%, which is still significantly lower than we see in the northern cities, averaging between 6 and 7%. Not only that, with the appreciation estimates in cities like Liverpool sitting at over 31%, an appreciation estimate of around about 20% by 2029 for Devon, means you're missing almost 10% of growth on your asset. With the businesses being so seasonal, you're going to have high season rates in July and August with 100% occupancy, making you an incredible return on your investment. But then, around the rest of the year, it will drop to more like 20, 30, maybe 40% at the most occupancy rates for the month, and a low season nightly rate, which just doesn't stack up for the amount of running it takes to actually manage that as your investment. If you are considering Devon for your purchase, you need to be extremely strategic when selecting the location. Spend some time absorbing the data for winter rates versus summer rates and the average occupancies and what creates those occupancies. Maybe some kind of unique feature, maybe a view of the sea. These kind of things will be really important when trying to push the nightly rates up and trying to keep as high an occupancy rate as you possibly can. But don't forget, when managing this type of asset, it's significantly more labor intensive. You have to do the check-ins and check-outs, changing the bedding, changing the linens, all of those things. And all of this takes time and requires money. When thinking about buy-to-let, the long and short of it is, there are significantly better returns able to be made elsewhere in the country with significantly less work to create those results. To give you another great example of a city that is fantastically beautiful, but a terrible place to invest, think about Cambridge, known of course for having one of the most famous universities on the planet. It's also an exceptionally affluent area, which would lead you to maybe think, great place to invest. But because of the level of affluence in this area, property prices are sky high, which means that the average rental yield in the area sits significantly lower than you would find in many other major cities across the UK. The mistake that investors make is they assume education and affluence leads to fantastic returns. I mean, after all, it's Cambridge. To give you a good example of this, I have a family friend who went to university at Cambridge. His parents decided to buy a property in Cambridge for him to live in during the 5 years he was studying, rather than paying rent. What they found is that when he completed his degree, that property is now renting for a low rental yield, sitting somewhere around 4%. When in fact, if they deployed that same capital now by selling the asset into one of the northern cities, they could be yielding more like sevens and also could be taking ownership of an asset that will go up in value exponentially when compared to the asset they now own in Cambridge. Cambridge, according to Zoopla, offers an average rental yield at 4.7%, which of course is higher than Kensington and Chelsea or Devon. Also, according to Savills, It offers 19.2% price growth by 2029. Those figures are nowhere near the levels you will see in some of the higher performing cities across the UK. Naturally, the student population of this city leads to extremely high tenant demand, which of course is great, but because of the affluence of the area and the extortionate prices you pay for buying property in those areas, what you actually find is you're tying up significantly bigger chunks of capital than you need to provide you with significantly lower returns. Makes no sense, right? In 2026, Cambridge wouldn't be the worst place to buy investment property, but it's absolutely nowhere near the best place either. Tying up bigger sums of capital to achieve lower investment returns does not make sense for a strategy when you're trying to scale an investment property. Instead, purchasing some of the areas that I'm going to discuss next as the best areas in the country to buy right now makes significantly more sense if you're looking for the highest returning possible assets. Our team spends countless hours every week researching the market and tracking where is the best place to invest. And we're releasing all of this data for free in our latest market report. This report gives you comprehensive data on all of the best UK investment cities and not just the ones we're covering here today, and can be downloaded by either scanning the code or clicking the link in the description. So, we've covered what areas to avoid. Now, let's take a deep dive into which areas have been performing and will continue to perform into 2026. The first example of a fantastic city to invest into in 2026 is one of the cities I've been referencing in the video, and that's Liverpool. Liverpool is currently ranked as the #1 city in the UK to buy investment property. Many investors assume the real opportunities lie by buying in the south of the country, but that couldn't be further from the truth. I dealt with a client a few years ago who was looking for their next investment property. The client looked at Liverpool as a city of choice and made the decision that he didn't think the city was evolved enough to be the right fit for his next investment. He actually decided to buy an apartment in Birmingham instead, which is not a bad city to invest into by any stretch of the imagination. But he recently sold his property in Birmingham and has called us because he was looking to buy something else. When he asked how the previous property was doing that I had tried to sell him previously, he realized that the growth in the investment that he had made by buying in Birmingham had performed at a significantly lower level than if he had bought the asset that we'd guided him to previously in Liverpool. He was really disappointed and has decided to make sure his next investment purchase is Liverpool city centre. To give you some ideas as to why we see Liverpool as one of the best destinations in the country for investment property, first of all, it's home to 3 major universities: the University of Liverpool, Liverpool John Moores University, and Liverpool Hope University, and has one of the biggest and most expensive training hospitals in the country for people from all over the world to come and study medicine. Liverpool is home to major businesses, has 5.5 billion being spent regenerating the Liverpool city waterfront with over 4 million square foot of new commercial space expected. And it has 2 football stadia and the second biggest tourist pull in the country, of course outside of London, whereby we have people coming in to view all of our museums and attractions, including the famous Matthews Street Cavern Club, home of the Beatles. Liverpool is currently offering an average rental yield, according to Zoopla, at 7.7%, which is over double what you would find in some of my examples of bad investments, like Kensington, like Chelsea, and like Devon. It also has a capital appreciation forecast from Savills at 31.2% by 2029, making it the highest returning area of the UK, not only for yield, but also for capital appreciation. And you need both of those factors to end up with a fantastic performing investment. Remember the comparison that we made earlier on, where the average property price in Liverpool is sitting at around about £181,000. If you were to buy that £181,000 apartment today, and keep that apartment and sell it at the end of 2029, the average estimated value of that asset when you come to sell is sitting at over £232,000, making an incredible margin of appreciation that you can roll into your next investment. Or you can keep the property do a bit of clever refinancing, and use that capital uplift as the deposit to buy your next property. This is all part of compounding and is extremely important when buying investment-based assets. Liverpool as a city offers the perfect balance of immediate rental returns at the highest level, alongside the potential for fantastic long-term growth. The trick is, look for the areas with the big ongoing regeneration projects, like the Liverpool Waterways scheme, like the Knowledge Quarter, or like the Baltic Triangle, all of which are brilliant areas with huge sums of money being spent on regeneration, including improving transport links even. Just make sure to research specific areas of the city and not just the city as a whole, as some areas are much better for investment than others. Another great example of a high-performing investment city would be a city like Manchester. What people often assume is that maybe with Manchester, they've missed the boat. Prices are already too high, yields beginning to diminish, and a lot's been built. So is oversupply incoming? A good example of why thinking that would be a mistake is I had a client recently that bought 4 one-bedroom apartments from me in the Greengate area of Manchester city centre. This particular client bought those apartments off plan. By buying off plan, it meant that they could take advantage of below market value pricing on the purchase of those apartments by around about 15%. Now, not only when the building finished did they make an instant 15% in capital appreciation, but because they had bought the properties at this discounted price, they also managed to get a rental yield that stacked up to be exceptional and amongst the best returning assets in the country. And just like Liverpool, it's expected to see over 30% in capital appreciation by 2029. For many, Manchester is considered to be the second city of the UK. And a common pattern we're seeing is lots of companies that don't necessarily need to have premises in London are now moving their headquarters into the north, into cities like Manchester, where the average cost of your office is less, and also the average wage can be a little bit less too, meaning that the businesses can profit and thrive more when moving up here. With Manchester, the real trick is focus on areas of the city that have the strongest transport links or the major employers near them. Think of areas like Deansgate, areas like the Northern Quarter, areas like Media City. These are prime places where people want to work, but also where people can have fantastic lifestyles. And the real trick is, think of your target audience. The audience in these particular areas is going to be young working professionals. What is it that they want? These guys want the mod cons, all of the latest facilities, gyms, spas, cinema rooms, all of the things that will make it so that their apartment can be shown off. Also, it boosts the rental yield for yourself, because any apartment that has this level of facility package within it should lead to a significantly higher rental rate being willing to be paid to live there, which then leads to a higher yield for you and less void periods. The final example that I would like to use for today's video is a little bit of a curveball, but bear with me. There is plenty of substance to support my argument. That area is a place called Warrington, which is situated equidistant between Manchester and Liverpool. Now with Warrington, just like I was talking about earlier in the video, it doesn't have the glamorous appeal of many other cities in the UK and isn't a place that is the first thought of people when they think, I want to invest money into the UK property market. But that doesn't necessarily mean that it's a bad idea to buy assets there. With Warrington, this wasn't even a town on my radar at all. But we'd been doing some work over there and I'd started to do some research. And actually, I found by the time I'd completed my research on the area, that it's actually a brilliant location to buy investment property and an area that I'm considering for my next investment purchase. According to Zoopla, the average rental yield in Warrington is sitting currently at 6.3%. Again, doubling the averages seen in places like Kensington and places like Devon. The beauty with somewhere like Warrington is that Warrington's property prices have not yet boomed in the same way as we've seen with Liverpool and with Manchester. With Warrington, Entry-level prices are sitting between 20 and 25% lower than you would see in the two major cities I previously listed, which is great. It means your capital outlay is significantly less to be able to purchase, but you can still take advantage of the same kinds of level of returns. But not only that, the capital appreciation forecasted for Warrington in the coming 5-year period is also exceptional, largely due to a couple of major regeneration projects, the biggest of which has been making national news: the Northern Arc railway line, which is going to be a high-speed train line connecting Liverpool Lime Street to Manchester Piccadilly and Manchester Airport, and it only has Warrington Bank Station in between as the only stop. What that means is that we're going to have high-speed trains running from Warrington to Manchester Piccadilly in 16 minutes and from Warrington to Liverpool Lime Street in 21 minutes, meaning that there is a massive demographic of people that could live in the Warrington area and commute into the bigger cities, saving a little bit on the rents that you see in the two premium city areas. Now, I think it's hugely important to clarify something here. Doing your research and learning which are the best cities to invest into is absolutely fantastic, but it's not just about the city. It's about buying the right property in the right area of the city and at the right price. And that's something we can help you with. The best piece of advice I could give you if you're currently shopping for an investment property is to book an online consultation with one of the team this side with a wealth of experience to share with you and match you to your perfect next investment. Click the link in the description below and book an appointment with one of our consultants today for further info. Now you know which are the best cities to invest into in 2026 and which cities could be a bad idea for your next investment. But how do you actually use this to build real wealth? Because knowing where to invest is one thing, but knowing where to strategically put your money to grow wealth over time is a completely different thing. And that's exactly what we'll cover in our next video. Our next video will give insights on how to retire at 55 years old with £5,000 per calendar month in passive income from investment property. Make sure you tune in to find out how.